Hey everybody, and welcome to our DAT IQ weekly market update. This is our update for Tuesday, May 18th, 2021. I'm Ken Adamo, Chief of Analytics at DAT, joined by Ned Damon, who's our Principal Data Scientist, and Dean Croak, who is our Principal Industry Analyst. Welcome, guys.
Hey.
Howdy.
Good morning.
Everyone get those taxes filed?
Oh, yeah.
Kind of snuck up on me this year. I think last year it was pushed till what, July, I think? Never a fun day to, catch up with old Uncle Sam. But anyway, I digress. We have a really great show this week. A lot of really interesting stuff happening in the freight market. I hope everyone has their bingo cards out. We have another square to call out with the broken bridge in Memphis. Some alliteration there for you as well. For those not familiar, we're here every Tuesday at 10 a.m. Eastern, 7 a.m. Pacific, talking about trends in the freight markets, what we're seeing, and then how you can translate that into making better business decisions. As always, we leave a ton of time at the end for questions. We had a ton last week and the week prior, so I would encourage you to get those in early so that we have enough time to answer them. But we look forward to hearing from you, so please drop those into the chat or comment below in marketing. We'll get them over to us. So with that, I'm going to hop into the key points for this week. So the market's settling down a little bit, 2 weeks now removed from road check week, with the exception of flatbed, which is just kind of has a mind of its own, I would say, at this point. The spot market volumes dropped for the first time after 7 consecutive weeks of increases. Import volumes also down a tad bit, just under 5%. And then we're going to talk about that bridge closure in Memphis in more detail. I used to work at FedEx. Been over that bridge a bunch of times. I saw it interesting when we saw some of the pictures and it was rust on the face of it. I immediately thought someone's going to get fired, and Dean will update us on that in a few minutes. But with that, I'll turn it over to Dean to get into more detail.
Great. Yeah, thanks, Ken. Let's get started with the load-to truck ratio for this week's market update. Carriers returned to the market last week. There was a record-setting number of carriers took time off the week prior. So as a result, last week with carriers coming back, the load-to-truck ratio moved up about 3% to 7.61. In the refrigerated sector, load post volumes dropped a fair bit last week. They dropped by 10%. But of the three equipment types, reefer carriers typically take the most time off during road check week, so it's no surprise to see equipment post increase by 14% last week. That had the effect of decreasing the load to truck ratio to 15.27. In the flatbed sector, flatbed load post volumes dropped again last week. They were down 4%, but there was a 14% increase in equipment posts also. So as a result, the load to truck ratio dropped down under 100 after being over that for a couple of weeks, now down to just under 98 loads per truck. Having a look at the market condition index this week, just having a look at some of the big lanes that were moving the most in terms of rates. In our dry van market condition index, on the 1,000-mile haul from Denver to Chicago, rates continue to tighten. That's the second week in a row. Rates inbound to Chicago have been up on a number of lanes. They were up 10 cents a mile. In the last few weeks to 152. Not a lot of money per mile, but it is a backhaul lane. But that's the highest level they've been in 12 months. Out of Philly, carriers looking to load north out of Atlanta to Philly, they did pretty well last week. Rates bumped up to $4 a mile for top-end loads. The average was more like $3.36, and that's still 27 cents a mile higher than last month in April. Similar story out of Charlotte to Buffalo. Loads were averaging $3.63 a mile and just over $4 a mile on the high end. Having a quick look at the West Coast in Los Angeles and Ontario, outbound rates were up only 1 cent per mile last week. Capacity is still tight as loads from Ontario to Dallas hit a 12-month high at $3.32 a mile. Having a look at our refrigerated market condition index, again, our focus this week is on some of the produce markets. Fresno's a big one. They're pumping out about 10 million trays of strawberries each week. That's about 2,200 truckloads. A lot of volume coming out of there. Chicago loads out of Fresno skyrocketed last week, averaging $3.32 a mile. That's up 63 cents a mile in the last 3 weeks. Same story out of Florida. Rates from Lakeland to Chicago, they were up to $2.67. That's about $1.32 per mile higher than January at the start of this year. And in the number 2 market for imported produce from Mexico, reefer rates for loads to Los Angeles from Nogales, they're almost double this time last year, averaging $3.90, even as high as $4.62 for some loads. And in the flatbed market, after sitting around $1.85 for most of the year, loads on the 540-mile run from Jacksonville to New Orleans jumped last week to $2.43. That's up almost 50 cents a mile since April. And in our largest flatbed spot market in Houston, loads to Oklahoma City are now paying $3.30 a mile and as high as $3.74. That's almost $1 a mile higher since March, and they're still climbing on that lane. And on the short-haul lane from Cleveland to Harrisburg, rates are close to $5 a mile, averaging closer to $4.93 over the course of the week. Even bumped as high as $5.46 on some loads, and even loads in the other direction are also just as high. So it's a very profitable lane for flatbed carriers. Wrapping up with our year-over-year look at spot rates, the dry van market settled down slightly last week. That was following the acute capacity crunch during road check week, where rates jumped 13 cents a mile. Last week, they stayed flat at $2.42, so no movement last week. For context, spot rates in dry van are now just over $1 higher than this time last year, and about 60 cents a mile higher than the same week in 2018. In the refrigerated sector, spot rates cooled off last week, dropping 4 cents a mile, following the record level jump the week prior of 19 cents a mile during road check week, so down 4 cents to $2.78. That's excluding fuel. Reefer spot rates are now 94 cents a mile higher than this time last year, and about 63 cents a mile higher than this time in 2018. And wrapping up with flatbed, capacity continues to tighten in the flatbed sector. Spot rates are up another 7 cents a mile last week. They were topping out at $2.74 a mile on average to all destination. That's excluding fuel. Flatbed rates are now $1.01 per mile higher than the same week last year, and about 28 cents a mile higher than the record-setting 2018. So that's it for this week's market update. If you'd like to find out more about what's happening in freight, go to dat.com/market update and download the weekly freight market update. Over to you, Ned, for the forecast.
Howdy, howdy. So we're going to be going through our forecast charts. We're going to be starting off with our van forecast. So you can see the blue line shows the market rate measured by DAT. And then off to the right, you can see our various strands of spaghetti that represent a couple of different modeling approaches that we have. In the red is our short-term model, which is focused more on just immediate concerns. In green, you can see RateCast, which is our flagship model, and it takes into account a little bit more historical weighting and a lot more seasonal considerations. And then in the middle between the two in gold and silver, you can see our two blended forecasts, which are mixtures of those two models in different ways and in different amounts. Here, there's a fair bit of model agreement about directionality. Everybody's expecting things to be heading up and to the right for at least the near future. There's just kind of a disagreement about the degree and the amount of taper, where RateCast is a little bit less bullish, expecting things to start tapering off as we head into mid-June, whereas the short term is continuing that trend straightforward as the short term likes to do. Moving on next to the refrigerated space, once again, you can see in the blue the market rates measured by DAT, and then off to the right, our modeling suite. Once again, there's a fair bit of model agreement, although this time there's a lot tighter banding, with the short term in red expecting up and to the right, our RateCast, our flagship model, in green expecting maybe a little bit of pullback initially, but then the seasonal forces reasserting themselves and a continued upward growth heading into the middle part of June, and the blended forecast kind of mixing the space, but leaning a little bit more towards the short-term model. Finally, we're moving into the flatbed space, and here it's pretty simple story. Blue, once again, is the market rates measured by DAT. And then off to the right, we have short term, which is up and to the right, RateCast, which is also up and to the right, but at a slightly reduced slope, and the blended forecast leaning much more heavily towards the short term model going into the next period. The streak that keeps on streaking for a flatbed has continued to go, and I feel like the short-term model has been a pretty good guide. There's not a lot of signs of downward pressure in that market, and so there's going to be some interesting times ahead. With the forecast covered, we're now going to move to an interview with Trent Broberg of Acertus.
What are some of the big things that you see coming down the pike for our industry over the next few years?
Yeah, well, hopefully, first and foremost, some normalcy. If there is such a thing, I think we are a very cyclical industry. There's no shocker there. Those that have been in the industry for more than maybe 3 years, if we go pre-COVID, understand that it's a very cyclical industry. We've got seasonality trends that you can pretty much, really stick a budget to in most years pre-COVID. So hopefully we'll see some normalcy. We'll see things come back to, from an OEM perspective, we'll see those supply chains for semiconductors come back maybe inshore or at least multi-sourcing from these OEMs so that we're not in these binds that we have today. So I think it'll really be a transition to less single threading and more understanding on how you can diversify a little bit so you've got that downside protection like we talked about earlier.
Yeah, that was a really great conversation with Trent, and thanks to him for joining us. I recommend checking that out if you have any interest in kind of some of the ins and outs of hauling for the auto industry, but then just some of the cool stuff that they're doing. I learned a ton during our conversation. It's a company that sort of, is very poised for success given the current state of the automobile market right now. Before we jump into our Ask IQ question of the week, again, I just want to put a call out. If you guys have any questions or thoughts or comments, drop them down below, and our marketing team will fire those over to us in the background. But with that, Ned, want to get us with the official question of the week?
I will get with the official question of the week and my favorite question of the week, which is, how will the I-40 bridge shutdown in Memphis change short and long-term freight rates?
As we always do, we'll kick it off with Dean.
Yeah, just to level set everybody, just to make sure we've all got the latest information. There's been a lot of talk about our C- rating that our national highways and bridges got recently by the Engineering Society. There's about 45,000 structurally deficient bridges. I guess this one now is in the top 10 of bridges in most need of repair. The story is that there was a drone footage survey done 2 years ago. The crack that was visible, if you have a look at the footage on Arkansas DAT website, you can see the crack clearly visible 2 years ago. Apparently that failed the inspection process. So as a result, an employee was let go today, according to news on CNN. There's a 2-stage repair. They're going to put some steel plates down tomorrow to allow the bigger construction and heavy machines to move onto the bridge. No timeline yet as to when it'll be complete. The backlog of 60 tugs and 1,000 barges was cleared Friday. But the bigger backlog, of course, is the diversion of 12,500 trucks per day from the I-40 over to the I-55. And that's, of course, eastbound is where a lot of that traffic is. The I-55 already handles about 14,000 trucks a day. So when you put the additional traffic from the I-40 eastbound onto the 55 eastbound, you're running about 1,100 trucks per hour. So it's about 1,100 trucks per hour volume. And what that's done, according to the Arkansas Truck Association, it's turned the I-55 8-minute drive into an average of 84 minutes. And they put a cost of that at about $2.4 million a day to the trucking industry. So right now, you can watch the Texas DOT live cams and see the traffic banking up over the course of a day. Mostly the traffic is banking up on the westbound side of the bridge, and it'll bank up a mile or so before the 55-40 split. So a lot of traffic being delayed. That extra hour and a half is, of course, coming off the transit time and causing some drivers to miss their appointment windows. And we'll continue to dig into the impact on the freight market as it evolves.
Is there a lot of ability, like if you're taking a long haul, is there a lot of ability to route around the affected area?
It's a difficult area because you've got to go quite a bit further south or north to get across the Mississippi River to come back down. So I'm guessing that right now the numbers work out. It's probably better to stay in the traffic than it is to spend that extra time running north and south.
Mm-hmm.
Yeah, I'm looking at a map, right? The next big interstate crossing is north, all the way to
Dyersburg, I think it is.
Dyersburg on is that 155? I mean, you wouldn't do that. I just can't imagine. If you've ever been to Memphis, I-40 is the one that goes over Mud Island, and then you see the old the pyramid that is now Bass Pro Shop and hotel. So that corridor of, there's just no great way to connect. I mean, what would they really be doing? Would they be going down Riverside? I don't know where all those trucks are really going to go to get north and south. I mean,
right.
It's going to be hectic. I know that for sure. Because then you have all the traffic coming up from the airport, right? So we'll usually come up, what would that be, 55, and then loop around to catch going west, right? Go north a little bit, jog north, and then head west from Memphis International. So, I mean, I think time is of the essence to get this thing resolved, or else I think it's going to cause some severe disruption in that area. Certainly before peak. I mean, I have to imagine it'll be resolved before peak, but once the e-commerce traffic starts coming in out of Memphis, this definitely needs to be resolved by then.
I mean, a lot of your traffic volume out of there at night that's sort of FedEx related, Ken, you'd know this better than anybody, but a lot of that's moving, at night when there's not as much traffic volume. And looking at the live cams, there certainly seems to be not much traffic delay heading west out of the city across the 55. It's more eastbound that seems to be the big problem at the moment.
I mean, that 55 bridge isn't like a new state-of-the-art, 7-mile bridge going down to Key West or the one in Tampa Bay. I mean, it's it's a little dated as well, I would say. I mean,
I think this one is 68 years old. I think it's something like that. I have to check my numbers, but the structurally deficient bridges are typically about double the age of bridges in good conditions in the country. So there's a lot of work to be done on our bridges just overall.
Yeah, I mean, I think it just highlights some of the fragility that we have at certain points around the country where, something major happens in one of the big areas like Houston or Memphis or Louisville. Chicago's a little different, right? Because there's so many points out. Chicago's a bit insulated and kind of diversified if you think about it that way. Memphis is kind of a weird choke point because it's really kind of in the middle of nowhere. I mean, getting to Memphis is a beast. Anymore, anyway, with FedEx monopolizing a lot of the flight schedules. Anything else as it relates to, I saw after the Colony Pipeline happened, there was a job posting that went up for a cybersecurity advisor. So I wonder if there's going to be a new job posting this week for a bridge inspection advisor for the Tennessee Department of Transportation. Yeah. Is it a joint-owned bridge, Dean, between Arkansas and?
Good question. I don't know.
Stump the Dean. That should be a new segment. Stump Dean.
We got a bunch of questions
coming in, so maybe we get started on those. And if you have any more, we'll hang around and make sure we get to them.
Absolutely. Ahmed says, I might have missed it, but I haven't seen any info on drayage rates. Can you please comment? We don't really talk about drayage rates very much on this show.
Extreme. Extreme. I was talking to an intermediary, I guess you'd say, not a true broker, last week, and they first reported about 4 to 5 weeks ago that they were paying $7,000 to $10,000 in drayage to go from Baltimore to Buffalo, Milwaukee, Chicago, Green Bay. All right. I mean, those are general rates; those weren't very specific. The destination would obviously play a part, and that's really not letting up. Unless you're hearing differently, Dean. I mean, these rates are just so a lot of the levers you'd pull to kind of, maybe do like a short dray move and then transload onto a full truckload and move it out. Those options are very, very limited. Short haul dray to a rail hub and put it on the rail. I mean, good luck right now coming from a lot of these ocean ports, especially heavy industrial ports like Baltimore. Yeah. But what are you seeing, Dean?
It's just there's like a sort of a concertina effect or a ripple effect. You've got, if you look back from the end delivery point, you've got congested warehouses, people trying to restock inventories. Then you've got containers sitting on top of chassis longer. Carriers are trying to pressure their shippers to unload them quicker. And that just ties up chassis, the chassis rolling stock even more back at the rail yards or the ports. And of course, then you've got most of the intermodal ramps are landlocked. So they actually don't have a lot of space when it comes to storing more containers or more chassis trailers. So there's a ripple effect that goes through the whole supply chain, and it starts with vessels and anchor, dock delays, and then it just flows right through to when they're trying to unload the container. And that, of course, is a problem that's going to take us quite a few months, I think, to work its way out.
Yeah, the chassis shortage is very real. And again, if you don't have the option to do like a short tray move inland,
right? Because
cross-dock space is completely jammed up, so all your transloading points are going to be difficult right now. I mean, that's just a weird concept, right? I mean, is that typical? It's an area that I don't have a ton of expertise in. Even in like slower markets, you wouldn't dray something all the way from like a Baltimore to Milwaukee, right? I mean, you would just bring it inland and then transload and consolidate.
Yeah, normally you would when capacity's loose, you just transload it. But of course, we've got people that are building warehouses. They're trying to find space to build more warehouses closer to urban populations. So just warehouses are in high demand, period, let alone warehouses specifically for transloading. So it is unusual, but I'd noticed something in the last 2 or 3 years, and it had to do with I was seeing more and more Class 8 trucks with sleeper cabs moving chassis trailers and 40-foot containers much further inland, even as far as Chicago out of Savannah. And of course, that was 2019 when rates were lower. Now, of course, we've got a supply shortage of both equipment and drivers and equipment, and shippers are left with very little option but to move those 40-foot containers on whatever means they can at the moment.
That's wild. Savannah to Chicago is a dray move. I mean, that would have to be astronomical. You're probably looking even in a low rate period at $15,000.
Right.
Because you're going to pay round trip. That drayman's not going to take something back from Chicago to Savannah. They have to bring the empty chassis back, right?
Well, unless they can do a street turn and reload it with export, right? They might de-hire the box and send it back empty to Prince Rupert, British Columbia, to go back to Asia that way, or might do something creative. So, but you've still got that equipment looking for some sort of load back out on that chassis trailer at some point.
Yeah, I mean,
yeah.
How much export volume is going from Chicago to Savannah, not on the you know what I mean? It's like that's a unicorn almost.
Right.
Like onesie twosie, you could probably figure something out, but to do that in mass would seemingly be completely infeasible.
Yep.
All right, we'll talk about this all day if Ed doesn't move us along.
I will move you along, but I just have one question that I want to get in. So, Dean, one thing that you said is that it's going to take months to resolve, but by the time that we are looking months in the future, we're starting to get into e-commerce season into the fall as people getting stocked up. So, that seems pretty grim for the rest of the year.
A lot of the experts in the industry are saying much that, because I think what's happening is because capacity is so tight. There's so many choke points in the supply chain. That inventory that we normally see coming in the fall, there's kind of that general saying that if it's not in warehouses in October, it won't be ready for the Christmas holiday season. That volume, I think, is coming through now because the warehouses and factories in China didn't close down during Chinese New Year. They kept that volume coming. That's why we're seeing higher volume now. I think there's a lot more volume coming towards us now that'll be pulled forward from the end of the year. Before we see some sort of leveling off or return to normalcy in terms of inventory levels.
I mean, even in a normal year, you're looking post 4th of July, the ocean traffic should start ramping. Like we should start seeing those sailings booked with the retail freight, right? So if that stuff starts moving on an 11 to 13 day transit, mid to late July, it's here in August. It's warehoused, transloaded, consolidated, broken and rebulked, and then it's hitting the warehouse by September, October.
Right.
There's not a lot of wiggle room.
And we're seeing blank sailings this week, containers being rolled over already from vessel to vessel. So capacity looks like it might even tighten further on the ocean side. And of course the flow and effect of all of the vessels sitting at anchor is they're out of sequence. They're sitting for 8 days on average at anchor off Los Angeles, where there's a high volume of imported freight coming in from Asia. That throws everyone out of cycle, heading back in the other direction.
Let's just hope nothing else happens in the near future. Moving forward, Kevin asks, do you have any insight in forecasting to Toronto from the major U.S. markets for produce? I can talk about the forecasting part in this. We currently don't do a lot of Canadian forecasting. It's tricky. But do we have any insight?
Ned, our sister company LoadLink has a really good monthly report they push out that talks a little bit about bidirectional volume and spot rates. That might be a good place for Kevin to go.
Yeah.
LoadLink.
Do we have loadlink.com? Thank you. Yeah.
Yep.
I'll see if we can get any more information pulled together by the end of the show. Stefan asks, any thoughts on the state of diesel? Is this spike associated with the Colonial Pipeline?
That's the current consensus. I think it was up about, the EIA was up about something at just over 6.8 cents this week. So the general consensus from industry experts is that the shortages on some of those gas stations in the southeast is part of that.
We also have a conflict brewing in the Middle East, right, which always puts upward pressure on petroleum products, right?
Yeah.
Yep.
And then, well, is there going to be downward pressure because summer driving season is going to hopefully be more driving, and so you get more different like offsets because of the way that petroleum is refined? I don't know.
I see mainly bullish trends over the summer. I don't see any let up on this or any systemic reason why we'd see a let up. I mean, heaven forbid we get a major Gulf hurricane that kind of rips through. Even if it doesn't, hit land, it's going to shut down the Gulf Coast refineries, which could put upward. I mean, summer doesn't bring with it typically, unless I'm totally mistaken and have forgotten something crucial, which I'm sure Dean will correct me on. But I don't see many deflationary pressures in petroleum products over the summer, typically.
Not normally. Normally, you've got more miles, faster miles, more fuel being burned. You've got more demand on the barrel of oil for other middle distillates and gasoline as more people are driving around. So there's more inflationary factors than there is anything else at the moment.
I would say I think that's probably solid. I don't see any reason otherwise. I was talking to a few folks yesterday, partners of ours, and I mean we're at a quarter and a half through the year, right? I mean May is pretty much going to be wrapped up here shortly. Where we're halfway through May. June will go by in a blink. I'm starting to run out of reasons to think things are going to turn at some point this year. I don't know. What do you guys think?
I mean, that's what I was poking Dean about is, we're heading into the hot months of summer. It's already really hot. There seems to be just one gosh darn thing after another coming up that's like putting little kinks into the supply chain, and there's just not a lot of ability to process them quickly.
I mean, we just got so much demand, right, for all these different types of freight being hauled. You've got cherry season starting we're in the cherry season in the Pacific Northwest already. So there's going to be a lot of volume moving in the reefer market as restaurants open. We've still got a lot of demand for consumer packaged goods coming in from overseas. There's just, on top of all of that, we've got equipment shortages. And then the biggest issue, though, this is a supply-driven crisis, right? And it's turning out to be right now, it'll be, I think, two phases. One is we've got a really, there's an acute capacity crunch when it comes to drivers. Just finding enough drivers that'll eventually seat these trucks that come online. And we don't think that there'll be sort of any meaningful increase in OEM output until the second half of this year. And then you'll start to see a lot more volume come into the market next year in terms of new truck orders, new trucks and trailers. The biggest issue is where do drivers come from right now, given there's so much pressure in other industries to find people to come back to work. That's the biggest challenge.
Do you really think, Dean, that I know we've been saying this, do you really think these OEMs are going to deliver in the second half? I mean, reasonably in the second half?
That's best case scenario if they can get their semiconductor chips. Absolutely.
I mean, fourth quarter seems like wildly optimistic.
Right.
I mean, I've seen some of the drone footage of, was it Tennessee and Kentucky, the two giant motor speedways down there where the Ford's parking their light duty trucks.
Right.
Chevrolet, I just read General Motors is shipping Chevrolet and GMC branded trucks without the cylinder deactivation chips for fuel economy. I was just reading that yesterday. You can't do that with a Class 8 truck, right? I mean, there's so many more electronically controlled emissions, and the diesel tuning and ELD integration points are just My goodness. I don't know. I think we could be seeing late H1 2022 before we see material increases in deliveries. And then you got to wonder at that point, do some of those orders get canceled?
As was the case in 18. Yep.
You know what I don't know?
19. Yep.
And maybe someone can help us out if none of us really have insight on this, is like, is your interest rate locked? Right? If you're a business ordering these Class 8 trucks and you buy them in Q1 2021 when interest rates are at all-time lows, and you don't actually take delivery of the vehicle, which is when the note would start, right, in 2022, when presumably interest rates will climb, how does that shake out?
I don't know.
I mean, are the banks going to honor the interest rate that were put in place when these things were locked? Because I mean, most of these vehicles are financed or leased, I would assume.
Right. I don't know.
As one more tiny
should translate to higher interest rates, right? I mean, that's kind of economics 101. But who knows? Ned?
I had one more little cheery note on the semiconductor situation, and that's that the vast majority of semiconductors are produced in like a 90 square mile area on Taiwan. So, just.
And it burnt down right before the height of the pandemic, and then as they were rebuilding it, and then they switched to consumer electronics, thinking that it was going to take a lot longer than expected for vehicle purchases to come back. You read that story, and it's just like, goodness gracious. Maybe the three of us should start a semiconductor plant in Northeast Ohio or Northwest Oregon. Probably Ohio. It's probably more conducive to business. The heart of it all.
Yes. Unfortunately, I mean, not to be Debbie Downer on this obviously whimsical plan, but spinning up new semiconductor manufacturing is really, 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 really hard. Where like the number of engineers and technicians and like the manual skill that you need to be able to fab things at the levels that are required. I mean, I know that not to go all geopolitics here, but China has been trying to spin up a lot of semiconductor manufacturing, and they've been having a hell of a time. It's like the aerospace industry where like there's a lot of mechanical know-how, and it's tough to like spin up something greenfield without having a lot of the experience that people have gotten.
Yeah. I mean, again, not to be a curmudgeon. I'm exactly 1 week away from a birthday, so I'll sit on my porch rocking chair for a minute and sip my lemonade. But you can only cut corners for so many decades on like a global economic scale, and then you can't be that shocked when it sort of comes home to roost, right? And I'm not playing on anyone's hardship here, but when the city of Houston, they built their entire system, their drainage system, their levee system, their water control system to withstand they had a choice to build it for like a 75 or 150-year storm, and they chose a 75-year storm. And then they got a 150-year storm and everything flooded. And it's like, well, you can only insulate yourselves so much from the consequences that you willingly accepted and entered into as part of like the contract. So when you've built, the entire global supply chain on a shoestring, and then all of a sudden your shoes come untied, hopefully we learn from it as an industry and kind of a global network of providers and suppliers in this space, that maybe we need some redundancy, even if it comes at a kind of carrying cost, even in the lean times. But I'll get off my porch here for a minute.
We have one final comment before we wrap, and that's Proactive X says, "Freight nerds, speak it."
I should get that tattooed on my arm. Jordan had a quick question. You want to hit that real quick?
Oh, sorry. Yeah, no, I totally missed it. Can you speak more to the conditions in the flatbed market? I hear all the reasons for high rates with vans, reefers, etc. Is it just spilling over to the flatbed market as well?
Have you bought a 2x4 in the past few months? Steel is up, what, 300%, 400%? Rolled steel?
Yep.
So here's the thing with flatbeds, and this is my working assumption that I'm testing. I haven't validated this yet, but so it's a lot easier to pass along the cost of the transportation on a discrete shipment level for flatbed, because it's mainly B2B and it's mainly industrial or sort of large orders that are negotiated on a per shipment basis. So if I buy 3 rolls of steel this week and I buy 3 rolls of steel next week, and the cost of that transportation went up, a lot of times, I'm not saying it's all the time, but a lot of times that can be passed along more kind of frictionless to the consignee, right, of who's getting that freight. Whereas if you have a 53-foot dry box full of televisions going to Walmart, Target, whoever, right, to just spread the love around, it's going to be a lot harder if you had to cover that on the spot market to pass the increase along on a per TV basis, right? A lot of the times that's fixed, and these are fixed contracts, and that's sort of, there's all these mechanics at play. Flatbed also has a much lower percent contract, as a whole. So a lot more of that freight moving on the spot market. So again, all of these things make it there's much less friction as it pertains to passing the price increases along, which is why you tend to see these unbounded spikes. And then also some of the contractions that can happen as well as rates fall. Did I miss anything? Did I overlook anything? Get anything wrong?
I mean, one thing that I might add is that the flatbed market, at least from my perspective, is a lot more specialized than the van or the reefer market. So like your supply that you can draw on to kind of carry over the bumps is a lot smaller. Like the pool is a lot less big, so when you heat it up, it gets hotter faster.
Yeah,
for particular equipment.
And you're making a lot more money on the goods that are being hauled.
Right. And it's a lot of project freight too, so you've got a lot of one-off destinations, a lot of time under cranes, a lot of side loading with forklifts, so you've got a lot more time on duty not driving. You've just got simple, it's supply and demand. You've got a lot more demand for dimension lumber, building materials, oil industry, pipe. So there's a lot of steel moving. It's a sector where it has been on the rise, but the latest numbers out today may give us some pause here. The latest housing numbers came out from the Census Bureau. Single-family housing starts dropped 13% in April on reports that a lot of builders are just simply laying foundations and then holding off on the framing because of the skyrocketing prices.
It hurts. It hurts my soul because I've been staring at a foundation for a month now.
Right.
Of my garage. A lot of these people building tract homes too, they're locked into the price. They can't pass that lumber price along, like the Pulte's, exactly. I don't know what you guys have geographically, but we have like Pulte and Ryan and all of those. Yeah. They're building a fixed cost home, and they're actually asking Congress and the government for help. It's borderline like unbelievable what's happening in the building materials market right now. I just even in the secondary home market, I don't understand how this doesn't result in some, I don't know what the ramification will be, but some like massive negative economic ramification.
I mean, you guys were talking at the start of the show, it's also not like there's a lot of supply that's coming to the rescue, where like it takes a lot of time to put sawmills online, and from what you guys were saying, like there's just no extra supply that's going to magically ride in and drive things down.
Yeah, I'm sure marketing wouldn't appreciate vulgarity on our program, but I think the something would hit the fan. When I think the something will hit the fan, it will be that once banks are allowed to foreclose, I think the proverbial pin, pulling the ball of string, whatever you want to call, whatever idiom you want to use. I think we're like the average person who's behind is normally 90 days before foreclosure. We're sitting at like 10 or 11 months right now. Latest stats I saw. It's going to be let's just hope it doesn't come. We got to wrap up before we.
Sorry.
The sky is falling. The sky is falling. It's certainly not falling if you have some trees that you're trying to sell. That's for sure. So with that, check out Dean's market update, the written report. Tons of great information. Any additional questions? AskIQ@DAT.com. Highly recommend the Assertis Trent Broberg video, especially if you're looking to even buy a car. Super informative, as well as all the other ones are up on our website. Chris Kaplis' Freight Find podcast. Want to shout out and thank the TIA for putting on an awesome virtual conference last week. Tons of great sessions, and not just ours, even though we think ours were pretty cool too. And with that, we'll be back next week, Tuesday at 10 Eastern, and we hope to see you all then. Have a great rest of your week. Bye.
Bye all.
Bye all.